Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. This is Abel Pacheco, your host for the Five Talents Podcast. We are with another amazing guest, Mr. Venkat Avasarala. Mr. Venkat, how's it going, brother?
Doing well. Thanks for having me, Abel.
I appreciate it. The pleasure is all mine. I'm humbled. I'm grateful. I'm thankful that you would take a few minutes out of your day to join us and our listeners, because you are one of those amazing individuals that's done amazing things, and that you fit right in with our guests, my friend. I know that we're going to learn a lot. So grab a pen and a piece of paper, and if you're running or jogging or in your car or something, when you get home, you want to hit rewind on this one if you're listening on the podcast. But we'll kick this thing off. So if you don't know Venkat, he's a seasoned real estate professional. His main focus today is ground up development for market rate multifamily properties. He spent a number of years, though, acquiring value add workforce housing, just really great multifamily properties in some of the Sunbelt states. And while he's in 3,000 existing apartment units today, he's also developing about 500 units of ground up new development construction. It's a lot of real estate. It's valued above $400 million, almost half a billion dollars. I'm sure he'll be there pretty soon. And he's raised over $85 million to complete these projects. So he is one of those individuals that knows how to do it, leverage the right team, right people, and we'll get after it. So Venkat, let me turn it over to you, sir. In your own words, tell us who you are and what you do.
Well, like you introduced, I'm Venkat Avasarala, based in Dallas, Texas. And my background is I'm an electrical engineer by education. I came to United States back in 2002, originally born and brought up in India. Got my master's degree in electrical engineering. Couldn't land a job in electrical engineering because there was no entry-level jobs back then. So went and worked in IT. So after did a bit of a consulting, came to Dallas in 2006. So I was working everywhere, the East Coast, the West Coast, and everywhere. A couple of years I worked in Houston too. But 2006, I came here to take a project, and that's when I decided to settle down in Dallas, Texas, and then eventually gave up my IT career back in 2018. And the reason for that is 2016 is when I started doing some commercial real estate. And I got to a point in 2018 where I had to decide, right? Because do I want to keep my day job or do I want to grow on the commercial side? And I had to give up one of them. It's just too much. So I chose to give up my day job.
Yeah. And it's awesome because I meet so many people in multifamily today that came and grew up kind of in our space. I worked 13 years in tech as well. And while you were on the Oracle, ERP, SAP side, helping on that end, I was on the hosting side, of the infrastructure side at Rackspace. So we would host all the software for the amazing things. But that's awesome, man. You had a great run, 2004 to 2018, right?
2016 to 2018, 2.5 years. It took me about 2.5 years to achieve that financial independence. I love my job, man. I wanted to keep doing, but there was only 24 hours in the day, and just couldn't do both of them anymore. So I had to give up.
Well, I'm sorry, I should have clarified your corporate career, 2004 to 2018, and then you started doing real estate in 2016. What? Tell us some of the companies that you worked for in your corporate day job, your corporate career.
Well, the very first job I worked was back in 2004 was Roseland, New Jersey at ADP. And after that, worked for a couple of years at Halliburton in Houston.
Okay.
And then, see, back then we were on H-1B visa, right? So we got to stay employed. I cannot say that, you know what, I only want job here in Houston. I won't leave. You can't say that, right?
Yeah.
As long as you're on a work visa, you got to stay employed. And that's the requirement. So usually you see that, right? I mean, immigrants who come on a H-1B visa, right? So we travel everywhere, wherever the job takes us, kind of an attitude. So then I did a small gig at T-Mobile in Washington. So I started in East Coast, came to South, and then went to West. And then luckily I found a job while I was working at ADP, and I worked at PepsiCo for 6 years. In Headquarters Drive here in Plano. Was working on a large $4 billion project. So during the worst recession, I wasn't worried about my job because we were freaking busy. We're just so busy. Yeah. That's a blessing, right? I mean, that was a blessing. But after that project ended, I wanted to take a permanent job and just want to take it a little easier. Consulting is like always go, high stress environment. So I want to just take it a little easy. So just that is when I joined Bank of America as an employee, and it was a blast. I get to work on with best teams in the world. And also it was all SAP, mostly, all my projects are around SAP. There one project I worked on, Oracle Financials, which is another ERP, but mostly it's SAP and running teams on that.
Yeah. And if for those that are not tech or don't have any tech background, it's essentially talking about some of the most complex software, enterprise resource planning systems that these large entities and large companies put all of this information, the data, their crown jewels, data into the software platform. And having somebody like you, Venkat, it's that pinnacle of the software, whether it's engineering or kind of putting the stuff together or just helping them figure this stuff out, the flow of all this data and how to utilize it. And then you end up serving the top level executives at whichever company. So there's a lot of complexities there, but man, you were doing some very critical work for these large companies.
Absolutely. And also I got to work on projects, right? Not the production support, but on the projects. So you get immense amount of job satisfaction when you push something into the production and it's like, okay, we've been busting our bags for the last 2 years on this thing. Today it went into production. I mean, it's a great feeling. It's a lot of job satisfaction, keeps you motivated and keeps you going.
Yeah, that's awesome. And so you left as a SVP, Senior Vice President. So you weren't walking away from an entry job, even in that critical spot. You were one of the top pinnacle, leaders, type of role, pay, benefits, all the stock, all the good stuff that an SVP kind of deserves at one of these companies. Man, how did even the mindset come to say, okay, I gotta move over? What the heck?
It was very hard, man. I don't think I will, but if I ever want to go back into corporate IT, bank is where I want to work. I mean, they treat me good. They're a great employer to work for. And they took care of me. It was a very hard decision. Financially, it was an easy decision, but parting away from something, that you're part of for the last 6 years, it was very hard.
Yeah. So you were able to, before you left 2016 to 2018, there was a 2-year period where you were really doing both. You were you were raising capital, finding deals, putting deals together, and holding down, a very high level executive role. Tell us about the couple of years there.
Yeah. So you have to understand the progression, right? So in 2006, I came to Dallas, and one day I was driving to office, and I got to office, and then I saw some emergency services at one of the places I was working. I was like, what happened here? So apparently, there was mass layoffs, right? In 2007, actually, mid 2007. No, actually late 2007, almost at the beginning of recession, right? So mass layoffs and people are just fainting, crying, that kind of thing, And I was like, oh my God, I mean, that's not going to happen to me, that kind of thing. That was late 2007. So that is when I decided, you know what, I love my job. I want to continue doing this thing, but things like this will come and it's in nobody's control, even companies, right? They'll try their level best to, keep the pain to the minimum. But the economy, we are set up that way where we cannot just be guaranteed a job all the time. So it falls upon me to secure my own financial independence, right? So it quickly dawned upon it quickly dawned upon me that I have to take matters into my own hand on that. So I started buying some single family, like most of the people, right? I mean, I bought about 20 single family homes with my own money, and I've been managing them myself. And it was fun. It was fun, but it's not making a big substantial difference in my life, right? Even after having 20 single family properties, it's not like I can walk away from my job if I want to, kind of thing, right? So then I figured that, you know what, I got to do something else. And then that is when I started passively investing in multifamily, saw the results come in, got convinced that yes, this works, and got myself some education in that department. And late 2015 is when I started getting some education in multifamily space. And mid 2016 is when I took a partner, by the way, and we both put together this portfolio. And mid 2016 is when I did my first deal. And mid 2018 is when I actually gave up. So yeah, 2 years, it was crazy, right? I mean, it's just crazy. Because I'm new to syndication, there's just a lot of work, so many moving parts, and the stress anytime when things don't go the way they're supposed to, the stress that you're going to feel, because these are syndicated deals, right? There's a bunch of other people's money in it. It's not all my money, you know? So enormous stress. Those 2 years, it's still worth it. If I can go back in time and do it all over again, probably I'll do it again, but it's just worth it. It's very fulfilling that it helped me achieve that financial independence by mid 2018.
Wow, that's awesome, man. It's a feat. You've taken that 2 years and you shrunk it down to about a minute and a half, I think. And I know there was so much more complexity, time, effort, probably, I would imagine some stressful moments, some hard moments, both at work and with the real estate side, right? Did anybody, well, along the way, I know somebody had to tell you, hey, what are you doing over there outside of work? And you're probably getting more visible on that side. How did that happen? How did that?
See, even at work, I inspired so many people, right? I used to tell them what dawned upon me is like somehow people are so busy in lives, man. As long as you have a job, kids, school, soccer practices, deadlines at work, health issues, nobody have time to think about future, right? Most people, right? So what happens is even today and back then and even today, I try to inspire people saying that, hey, look, it doesn't have to be real estate, but it has to be something, right? You cannot have this single source of income. And people ask me that, oh, it's very risky. Are you sure you want to be that? Are you sure you want to depend on one job for the rest of your life? I mean, don't you think that is risky? Especially we have 2008 to prove that, right? I mean, that things can go really bad. So I openly share that information, what I'm doing, and I inspire people. And several people, actually, I couldn't talk anybody get into multifamily, but I talked a bunch of people get into single family at least something, right?
Yeah, something. Just pull the trigger. Process. Yeah.
Yeah.
Oh, that's awesome. Yeah, I 100% agree with that. When people do say it's risky, I think the riskier proposition is leaving it in maybe the government's hands and hoping that you're going to work or create or be able to put something in a 401k and it be there. And it's the outcome is already guaranteed. You will have to work till you're old and gray, and that's the outcome if you don't invest. If you don't invest for your future. My mom and dad, unfortunately, I mean, they're still working today. They're in their mid 70s. And, that's what kind of drives me and motivates me is like, I'm trying to finish as quickly. I want to say finish, but I'm trying to get into a position where I can help them as quickly as possible. And then also provide for me and my family. So where my children can see something a little different, for the next generation. And, my grandparents helped my parents and my parents helped me, and every generation should better the next one is how I'm looking at it.
And what I tell people is this, look, nothing is getting cheaper. Everything is getting expensive, right? Let's say we go to work, we earn money, we spend some of it, we save some of it. Well, you got to grow what you save, right? Because look, if you want to send your kids to college, just see how the college tuition prices are escalating. And let's say if you get sick and we have to pay for some or all of the medical procedures, I mean, look what's happening in the medical side, right? And if you want to buy a house and retire in that, look what's happening to the home prices, right? Everything is going prices and everything important in life is going up and up and up in prices. So we got to keep up with it. Otherwise, we are going backwards. The inflation is making our dollars, and especially the money printing that the Fed has been on, right? I mean, our the purchasing power of our dollar is getting depreciated every single day. So even for that, you have to keep investing and start growing money. And I tell people, real estate is one of the way. It's the most common way. But if you don't want to touch real estate, that's fine. But then you have to figure out a way how to build wealth.
Yeah. Yeah, I remember my parents' story saying, I remember we had 15 cents and we used to go buy 5 burgers and a fries down the street. And I'm like, 15 cents? And they go, well, I might be under exaggerating, but it was less than $1, and it feed like 4 or 5 people. Well, there's very rarely you're going to feed that many people with $1. And just like property, I bought a first single family house in 2006, 3-bedroom, 2-bathroom house in a very good cost, low cost of living market, San Antonio, Texas. It was 116,000. It was like 5 years old, so it was pretty new. And I wish I could find 20 of those today. It's just not going to happen. And just like a $10 million building for 100 units today is costly, more costly. I have a feeling we're not going to be able to find those deals at some point in the future. It's just going to continue on 20, 30, 40 years from now. We're going to say the same thing. I remember when we used to be able to do that, right?
Absolutely.
So yeah, we got to try to outpace
and there is
that.
a reason for that, right? If you go Google the word FRED, FRED, M1 money supply, the money which is in the country just before 2008 was $1.5 trillion for the whole country. That's all the M1 money supply is. Today, we have $18 trillion. That's like 12 times.
Yeah.
Right. I mean, 12 times of the money. So back then, and then we're not talking about ancient history. We're talking about early 2008 or late 2007. So if you have $1 back then in the country, now we have like $12. So it's just imagine, right? Everybody's purchasing power goes up. I mean, their ability to purchase stuff goes up, but there's a limited quantity of the goods and services, right? In this particular case, it's real estate, which has been in short supply lately. So the prices go up.
Yeah. I love it. This is not that I love that. I love this conversation because this opens eyes, opens people's minds to, hey, if you're not going to figure it out, no one's going to figure it out for you. You figure it out, take accountability, responsibility, and try to lay the groundwork, lay the tracks in front of you. And now it's time. So this has been great so far. Now let's move a little bit from this conversation because you took action. You understood what was going on. Probably, I'm imagining, took some education, probably worked with some great experienced people, some people that showed you, and then you learned a lot through the process. But for years, you bought some Dallas multifamily properties, 3,000 doors worth, and raised millions of dollars. How did that even happen, brother? Before we get to the development, how does that work?
Oh yeah, it wasn't easy, man, because even though I live in Dallas and have all these single family properties, I didn't get any credit in the multifamily world. So we got to start from the first floor back then.
Like, didn't your 10 years of single family help you? I go, no, you've never done one commercial deal. So
So back then, Dallas was so hard. We were getting 6% rent growth back then. And I want to get some of that. So me and my partner, we worked together and we turned in LOIs, so many LOIs. All the brokers were nice, but nobody awarded any deal. We couldn't even land a 60-unit deal just because we didn't have any track record, right? So me and my partner put our head together and said that, look, I mean, we can either keep doing this, right? And hopefully we'll get a deal one day. Because Dallas is kind of a center of the universe back then in the multifamily world. There's rapid appreciation in the rents, the property values, and all that. And as a newbie, we didn't stand any chance. So we said that, look, people will give us deals. It's just that we have to prove to them that we know what we're doing and we can raise money and we are trustworthy that when we sign on the contract, we'll do exactly what the contract says. That's all we got to prove, and people will give us the opportunities. So we went outside Texas completely, right? We went to Oklahoma and bought a 1963 built 100-unit property in Norman, Oklahoma. It's a 100-unit property in College Town, but boy, oh boy, it was tough. It was tough, especially for the first deal. We weren't ready for what's happening because that is when the oil took a big hit, and Oklahoma has a huge dependence on oil. And I find myself competing to a 2009 property. Being a C-class property, I was competing with Class A property because rent suddenly got depressed so much. So, but it taught me a lot of education. I mean, it gave me a lot of education managing that just 100-unit property. But yeah, we showed that experience, and believe it or not, we landed a deal in Phoenix, a 120-unit off-market property. And back then, Phoenix is still recovering from the 2008 crash. It was a late raiser, so we were able to get it. Today, no way. No, I mean, it's much hotter than our Texas markets. But back then in 2016, we were able to show that, look, we own 100 units. Why don't you give us this 120 units? And so we showed these two examples that, look, we can close these deals, and we showed it to our Dallas brokers. Now they started to take us seriously. They would really want to help us, right? It's just that they need to see evidence. They don't want to take a risk of giving my very first deal in Dallas because of the hot market. And then we started with 300 units in Dallas. It's so funny. Less than a year ago, they wouldn't award a 60 unit to us, but suddenly, okay, we'll get you started with 300 units, right? So after that, we keep buying mostly in Dallas. And lately we bought one in Colorado too, last year, October of last year. But otherwise, mostly our portfolio has been in Dallas.
Yeah, that's awesome.
Yeah.
Let me pause for a minute here because to highlight, there's a lot of people that would want to trade seats with you in terms of your portfolio and your real estate holdings today, your ability to perform, raise capital, and do it again and again and again. Now, as those individuals, the same ones that say, I want to go do that, I'm going to work hard, I'm going to go put it together, they face obstacle, opposition, and a challenge like no track record, not being able to find a deal that works, and it was just too hot of a market. Some people would just stop there. Now, the difference that I heard in your story is you realized there was an obstacle or barrier in your path, but you found a different path. And that's what I think the most successful real estate investors do is when you find an obstacle, you get kind of creative and figure out a way to work around it. Well, this isn't one deal we were talking about. We said, well, I want to be in DFW and I don't have a track record. Well, let's buy a deal in Oklahoma. Yeah, let's buy a deal in another market. Now I've got a track record to come back. And that was definitely one way to do it. And that's it,
Yeah.
right?
Yeah. And also the thing is, people get stuck. When they get stuck, you have to go ask for help. You have to network like hell. And more importantly, people have to like you so they'll help you, right?
Mm-hmm.
And you add value to them, they add value to you, you collaborate. You think we got here without any help? We had tons and tons of help. Landing the very first deal, there was actually a gentleman called Justin Martinez. He found that first deal. We did not. Me and my partner did not. He did. But this gentleman had other business that he has to focus on at the time. And he was contemplating, do I keep this deal or just give it away? Because if I keep this deal, I don't have time to do it and I have to bring some partners, right? So when you work hard, you get lucky, right? So this gentleman, he knows that we are very hungry. We're out there looking for deals. And he saw us so many times, talked to us, liked us, and he called us like, guys, do you want to come here and do this deal with me? Because I'm busy, I need some help. It's like, oh yeah, sign me up, right? So that's exactly how it happens. When you work hard, you get lucky. I don't know how that is, but it often is.
That's what I subscribe to the same, Venkat, is luck is where preparation and opportunity meet. And you absolutely prepared yourself. The opportunity came and that's luck. Yeah. And you prepared yourself by doing all of the underwriting, all of the LOIs, all of the offers, already talking to investors, more than likely. This is what we're going to go do. And bam, you know.
Yeah. And even on the second deal, right, we need some people to come sign it, somebody who has Fannie Mae experience, because our first one was Freddie Mac. The second one was Fannie Mae. We didn't have any Fannie Mae experience. Mm-hmm. So somebody we know came and signed for us, right? Tremendous help. Without their signature, there is no problem. There is no deal anymore, right? And we don't live in Arizona, but so we were able to find somebody who lives in San Diego who actually drove there. It was an off-market property, boilerplate kind of a deal. And then we were able to convince this guy to just get in his car in next 2 hours and start driving 4 hours in that heat and go to Arizona and tour that property for us. And we brought him in as a partner. So it's a huge collaboration. We had tons and tons of help along our way from so many great individuals in our life. We're blessed to have them.
Yeah, that's awesome. Well, that's
Yeah.
awesome. And yeah, man, a great story so far. I'm super pumped just to kind of you share it with us and our listeners. So, okay, so you moved, you've done a deal, you've done a second, you did a 300. Funny how that works. The law of the first deal, you get first one, and they just continue to come. And now you're raising capital. There's more of it. What in the world does 300 to 3,000 look like? How did that happen?
Right. No, honestly, we were not like looking to, okay, let's get to the 3,000, 4,000, 5,000 kind of a thing. It's just a process, right? One after another, one after another. We were buying one a quarter basically for a couple of years there until we hit you know what happened in 2020. So that kind of put a big stop for us because all of 2020, we bought just 50 units, right? But we were very active until late 2019, and several things changed in Dallas, in Texas markets. Our taxes and insurance started to go up, and we didn't see the same level of opportunity we saw until then. So we took a pause, and nothing wrong with that, right? I mean, if you're not sure about something, you have to stop, right? No point in rushing into things that you're not sure about. So that's what happened in late 2019 is the last time when we bought a Dallas property. All of 2020, we bought just a small property in Denver, Colorado, and that's doing very well. So yeah, that's pretty much it. But there is no plan or anything. It's just keep heads down, keep working kind of a thing. And especially we were able to scale a little faster once we both, me and my partner, we both gave up our jobs. And that lets us to scale a little bit faster.
Yeah, and all of the general partners. So I have an audience, I think, of two types: passive investors. Somebody's just trying to learn more about how it is we do these deals. You know, what something to learn from. Give them the nuggets. So let's pause here for a minute. Hello. You're listening to the 5 Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review, and we're going to send you a free copy. So thank you so much for subscribing to the 5 Talents Podcast. We really appreciate it. For the passive investors that are listening, what advice can you give them on finding great deals through great sponsors, through great markets? Give them a few of your nuggets, because you've obviously done a lot and had some success here.
I think the first thing is getting educated, right? So they have to get on as many sponsors webinars, assuming that sponsors are doing webinars, right? But that is where you get to keep it a little bit more interactive, right? Your concentration is there. This is happening in live. It's not a pre-recorded thing where you can skip kind of thing. That's why I don't never pre-record anything. All my webinars are live. They have to give me that 2 hours of their weeknights time, and have to bear with me here, right? So that they're paying attention. And you have to do that, right? So that you learn a ton of different ways of thinking, how the deals are being structured, how the value add is panning out. So that education has to be there. And outside the webinars also, there's tons. And today there is no excuse for ignorance, today, in these days, in the days of YouTube and all that.
Social, podcast, webinars,
Exactly.
seminar, all this stuff is available. And even
So
more so with COVID, even more so
exactly.
this year.
Exactly. So they have to educate themselves, and most importantly, need to be able to read the chart, 5-year cash flow projection chart, right? I mean, that's where everything is. That's where the meat is, right? If you can follow along, and if you're stuck somewhere, make a question and just send that email to the sponsor asking, hey, how does this work? And you don't have to do it forever, right? I mean, after 3, 4, 5 deals, vetting 3, 4, 5 deals, it becomes much more easier and natural to vet that. So that's one thing. The second thing I want to tell our passive investors is just broaden your scope. It's nice that if you can get to invest in a property in the town that you live in, excellent. But it can't be the only criteria. World is bigger, our country is bigger, opportunities are so many places, not just in our backyard, right? So have some open mind and learn about different metros, what's going on, what's the strengths and weaknesses of each metro, what was the history, how is the future looking like. And I understand this is work. I get it. It's not something that you can just click and read a couple of blogs and know everything. It's a process. Dedicate some time, at least an hour of a week. An hour of the week is plenty just to keep up with what's going on, right? But you have to spend that hour a week to educate yourself, because lately I've been focusing on Phoenix and Denver, and I have my reasons, right? And I know what I'm doing, right? Why I'm doing. But sometimes we hear from our investors said that, you know what, I live in Texas, I want to invest in my backyard, and it breaks my heart. It's like, look, it's actually easier for me. I live here too. It's easier for me to buy here, but I want to buy over there, and there's a reason. And you come to my webinar, I'll tell you what the reason is, right? So that's all. That's my just one pet peeve that I have with my investors. Just have a little bit open mind, hear us out, and why we're doing things the way we are.
Yeah, that's awesome. We did our first triple net lease, net sale leaseback deal on an industrial portfolio last year. And all my education, all the mentorship, everything that I've done has pretty much been residential real estate, and the commercial is still for people's housing, right? Commercial multifamily, call it residential, if you would. They live there, right? An individual person rents a room to sleep in. So the industrial part was like, wow, I've never done it before. And I had an open mind, like exactly what you said, to at least check it out. And when I saw it, I go, oh, this is pretty cool. It's a different way to earn. Now I didn't run in without experts, people that have done 20 plus deals. And we actually just had a podcast interview with them earlier, but that's the open mind part. Same thing with markets. I'm a bias towards Texas because I live here. I've invested for 13 years here. I feel like I know San Antonio. I feel like I know Texas. I feel like I know the space. However, like you're saying, we're not a tree. We can move. We can get up and move. And I'm not even just talking about literally. I don't even have to literally move there. I could just move my thought process or moment and look at some data in different markets or different asset classes or different something. And if you spend, I think I agree, an hour a week in a new area, a new subject matter, whether it's population, supply and demand, your industries in a certain city or metro or whatever, that's going to broaden your mindset and make you a more savvy investor, regardless of which market you end up choosing. And then the multifamily or the syndication spot of it, that's the beauty of it. Like somebody living in California or New York or Boston, if you don't want to invest in your area, you can invest somewhere else. Well, if we're living in Texas, we can do the same thing outside of our state, right?
Yeah.
So that's awesome. So in that pursuit, it's also led you to development. So talk to us about that transition.
Yeah. So here's what happened, right? I mean, early 2020 is when we started looking at development deals. Our very first development deal here is in Princeton, 156 units right on Highway 380, the project opposite to the Princeton High School. So here's our thought process on why we went into this construction, right? So never before the developers are being rewarded for their work that they are being rewarded right now. And let me explain, let me qualify that statement. So 5-10 years back, when the real estate is so cheap, right? You can buy an 8 cap, 9 cap, and some instances even 10 caps, right? So there is no reward for building new stuff. When you can buy something existing, which and start, you buy today, starts tomorrow, starting tomorrow, it cash flows. And when you, and there was not a big migration and all that. There is some migration, but not enough where it justifies a big construction, right? I mean, that you need to build so many units. So then back then, developers used to sell their properties at, let's say, 7.5 cap, something like that, even a primary metro like this. But today, a developer can sell their property at like a 4.5 cap, 4 cap, and I have seen a 3.5 cap in Austin. And that was just one deal in CoStar, but it happened, right? What does that tell you? You are being rewarded by very lucrative. It's a very lucrative endeavor for the developer now than ever before in the history of time, right? And the leverages are there. In good olden days, the leverages used to stop at 65% on the cost on leverage. But now there are debt funds who's giving stiff competition to the banks, and they want to become a lender. It's a fund. It's a debt fund. Even outside, I'm working with actually a fund outside US. It's a Canadian fund, and they want to lend up to like 80% on a construction loan. This was not happening.
They want to compete with the banks. The banks have senior position loan. For let me pause you real quick for the listeners, right? So for let's say basics of it, you have $20 million deal. Equity is our investors and our capital, and the debt side is the loan that's given. Just like on a $200,000 single family house, the bank wants to put in 80%, and you put in the 20%. That's your equity down payment. So if you remember, on a single family house, like an FHA loan, you only need like 5% to get in. And that would be a 95% loan to value. So the bank goes 95 and we bring in our equity at 5 on this 100K example, right? So on the bigger commercial multifamily deals, the senior debt or the mortgage company wants to lend us 80, 75, 65, 70, 80% as a stretch, right? To get there. And that's very, the higher the LTV, loan to value, the more risky it is for them. They want more of your equity down. But a debt fund is essentially a lot of capital all pulled together where they know they're taking a debt position, not an equity position. And so typically the equity side is the higher risk, which means a higher reward and a higher percentage of interest rates. Now, what Venkat's talking about is like the debt fund is they're willing to take a lower return, and that's their position, and they know that. So sorry to pause you, but go ahead, keep going.
That was a great service to your listeners. Yeah. So again, very compressed, very low cap rates that the developers can sell their properties. And also the leverage is there. The interest rates are low. So all these stars align for the first time since the beginning of the time for the developers. And it's very profitable, right? I mean, I definitely want to generate higher IRRs for my investors, doing those kind of deals. Because if you see, stock market has been on a tear. Bitcoin has been on a tear.
Wow,
anything
Bitcoin.
and everything you buy. And our real estate traditionally paid about 12 to 15% per year. In the traditional sense, it's a good return, but then again, it pales in comparison to these things. So I'm not saying that, I'm not advocating that, people who don't understand stocks and Bitcoin go throw money in it, but I'm just saying that it is happening. It's right in front of our eyes. We cannot ignore the returns those asset classes are producing. So what I want to do is I want to work on something which is a little bit more lucrative for our investors, which makes our time worthwhile by involving ourselves into these development deals. So what I started doing is to partner up with some veteran people with at least 20 years of experience, right? Somebody who have done this so many times, because I didn't have any development background, at least my partner should, right? So that's why I started partnering with some veteran developers and got involved in some construction projects. And also, if you think about it, right, I mean, COVID was like a nuclear attack on the lower end of our community, right? They are the ones who lost all the jobs. People who makes above the median income, like our median income of the United States is around $55,000. So people who make more than that, they're fine. They're fine. But the people who make less than $55,000 median income, they are the ones who got hit, right? That's where the majority of the job losses are. And I want to actually take it slow, catering to that segment until things go back. Because even today, after losing 25 million jobs, after getting about 14 to 15 million jobs back, we're still out 10 million jobs compared to 1 year before. So there is significant amount of pain. Now, these jobs will take time to come back because the easy ones, we got them back thanks to federal intervention. But as long as these 10 million jobs are out, there is still some pain in that area. So I want to take it easy on that area and want to cater to the people who are doing well, again, in the interest of my investors dollars, right? I mean, that's number one for me. That's number one priority for me. So I feel that we are getting better risk to reward returns, catering to the higher end of the community than the lower end. And also, I'm not talking about keeping these properties after we build them. I have every intention to actually sell them. If at all magically, then we get a great interest rate. If it still cash flows after we refinance it to a permanent loan, we'll consider keeping them. For the most part, the idea is to sell.
Got it. Well, that makes perfect sense. We are, in looking at right now HUD for this exact, topic, right? It's sub 3% interest rate, 80+% LTV. You can carry a percentage of the equity needed as a line of credit, not actually having cash in the deal. There's BRSPRA, builders, I don't know, whatever it's called. It's BSPRA. It kind of stands for like the equity that's already built into the deal when you start, creating it. And HUD, has a lot of like what you're saying, just ultra due diligence to make sure the market study, the feasibility study, all the things that are done correctly. But it's developing something that's probably pretty darn close to paying for something today as prices increase. Well, if I can develop it like property, an A class where I was paying for a B, it's, well, we gotta definitely look at it, right?
Absolutely.
Yeah. Well, this is awesome, man. And in the development side, where are you? One fully completed, one breaking ground, where are you in general in
Yes.
the development
Two
side?
in the breaking ground stage. One of them will be ready to lease up this October.
All right. The first one
Yeah.
is ready to go, brother. Well, congratulations. Are you leasing it up before selling it, like stabilizing it,
Oh,
or
yeah.
you're
Absolutely. Otherwise, these buildings don't have any value, right? We got to put the bodies in it and some paying tenants and has to establish that pro forma so that,
for a year or something along those lines?
See, I'd like to keep it 1 year from the date after the last unit is put in service, right?
Perfect.
So let's say,
fully
not
ramped
all
up pro
units
forma.
don't come online the same day, right? So, but I want to wait 1 year from the last day, from the day the last unit got delivered, so that we can qualify for the long-term tax treatment.
Yeah,
So
that's perfect. Get
yeah.
that sucker pre-leased up. Let's
Yeah.
get a model. Let's get it going. Well, that's awesome. Well, Venkat, is there anything we hadn't talked about today that you're really hoping I touched on, we hit on, anything in general that you wanted to say before we go? I know we're about that time.
Yeah, again, this is, I think the listeners are somebody who have some interest in investing. And I just want to encourage people, right? Somehow we are not taught in 18, 20 years of formal education about investing. We are not taught about how important is cash management, money management, right? Investing and all that. So what I would encourage people is to just talk to people like you, me, other syndicators, get in their webinars, have schedule one-on-one calls with all the people, and just educate yourself and be part of this thing, because not investing is not an option. And if real estate is not your thing, no problem. but you got to invest somewhere. You got to grow that money because everything else that you would want in future is going up in value, right? Costs more to get that college education, to get that Medicare, to get that house, to buy the car. Everything is going up in price, and we cannot just sit on cash and reduce our purchasing power every day. So you got to invest. So that is what my message is for everybody. And this is what I tell to all my coworkers when I was working for bank, and I tell to everybody, my friends, acquaintances, and all that: invest, invest, invest.
Very good. Thank you very much, Venkat. Where can the listeners reach out to you if they want to invest, they want to get in your world, they want to learn a little bit more? Where do they go reach out? And actually, who do you want to have reach out to you?
I don't have any particular set of people. If anybody, resonated with what I just said, yeah, reach out to me. Doesn't have to be an investor, even a JV partner. Yeah, if you're a JV partner, if you have a deal, I can bring equity, and the vice versa, right? So investors or JV partners, or anybody for that matter, yeah, you can reach out to me. And the best way to get hold of me is emailing me at Venkat, Venkat, at I have two businesses, Raven and Striker, but you can reach out to me at Raven like the bird, RAVEN, multifamily.com, or call me at 281-727-9238.
Very good. We'll put all that in the show notes, and you have it here. And we really appreciate you listening to the show. I hope you took some notes. I think there was more than a few value points here. And if you are loving the show, loving the content, loving the people that we're having, please subscribe, rate, and leave us a written review. They help so much. Really get the algorithm going and get other people and other listeners on. And reach out to Venkat. I love your first name too. I don't know if I've ever told you that. Every time I hear Venkat, I feel like, oh, the dude's a cool cat. So, that's literally what I think of every time I hear, oh, Venkat's here. This dude's a cool cat. But I really appreciate your time, man. And it's been a pleasure.
All right. Great.
All right. I'm Abel Pacheco. I'm your host. We'll see you on the next show. Thank you very much. Bye-bye. Thank you for listening to this episode of the 5 Talents Podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who followed their dreams and achieved massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents Podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked, tell us your favorite guest, give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents Podcast.